1. Define the two types of consolidation models: variable interest entity (VIE) model and voting interest model. The voting interest entity (VOE) model bases control on majority voting ownership. Under this model, an entity consolidates another when it owns, directly or indirectly, more than 50% of the outstanding voting shares. Majority ownership typically provides the power to direct operating and financial policies. This is the traditional consolidation approach and applies when control is achieved primarily through equity voting rights. The variable interest entity (VIE) model focuses on economic control rather than voting power. A reporting entity must consolidate a VIE if it has the power to direct the most significant activities of the entity and is exposed to its risks or benefits. Control under the VIE model may exist without majority ownership. Often, contractual arrangements rather than share ownership grant control, especially when the controlled entity lacks sufficient equity to finance its operations independently. Both models emphasize substance over legal form. The VOE model applies when voting rights determine control, while the VIE model applies when financial and operational control arises through contractual or economic arrangements. In both cases, consolidation ensures that financial statements reflect the true economic relationship and risk exposure of the controlling entity. J. Demonstrate an understanding of the three types of consolidation accounting: full consolidation, proportionate consolidation, and equity consolidation. Full consolidation includes 100% of subsidiary accounts. Under U.S. GAAP, when control exists, the parent consolidates all assets, liabilities, revenues, and expenses of the subsidiary on a line-by-line basis. The investment account is eliminated, and subsidiary equity accounts are removed. If less than 100% is owned, a non-controlling interest is reported within equity. Full consolidation reflects complete control and is the primary method required under GAAP. Proportionate consolidation includes only the investor's ownership share. Under this method, the investor reports its proportional share of the investee's assets, liabilities, revenues, and expenses. Although not generally used under current U.S. GAAP for subsidiaries, understanding this method is important conceptually. It reflects joint control arrangements where each party recognizes its direct share rather than the full amounts. Equity consolidation, equity method, applies when significant influence exists without control. When ownership is typically between 20% and 50%, the investor recognizes its share of the investee's net income as a single line item and adjusts the investment account accordingly. Dividends received reduce the investment balance rather than being recognized as revenue. The equity method does not combine line items but reflects economic influence. K. Demonstrate an understanding of intracompany balances and transactions that should be eliminated in consolidation. Intracompany balances must be eliminated in full. Receivables and payables between the parent and subsidiary are removed to avoid double counting. Loans between affiliated entities are eliminated, including related interest receivable and payable. Because consolidated statements treat the group as one economic entity, internal obligations do not represent real assets or liabilities from an external reporting perspective. Intracompany revenues and expenses are eliminated. Sales between parent and subsidiary, along with related cost of goods sold, must be removed to prevent overstating consolidated revenue and expenses. Similarly, intra-entity service fees, rent, and interest transactions are eliminated. Only transactions with external parties should appear in consolidated revenue and expense totals. Unrealized profits in ending inventory and assets must be adjusted. If goods are sold between affiliates and remain in ending inventory, the unrealized profit is eliminated until the inventory is sold to an outside party. This prevents artificial inflation of consolidated income. The goal of eliminations is to ensure consolidated net income and asset values reflect only transactions with external entities and true economic performance. L. Define integrated reporting, integrated thinking, and the integrated report, and demonstrate understanding of their relationship. Integrated reporting is a principles-based framework for communicating how an organization creates value over time. It combines financial and non-financial information into a single, cohesive narrative that explains strategy, governance, performance, and prospects. Unlike traditional financial reporting, integrated reporting emphasizes long-term value creation across multiple forms of capital. It is designed primarily for providers of financial capital but benefits broader stakeholders by presenting a holistic picture of organizational performance. Integrated thinking is the internal management philosophy underlying integrated reporting. It involves actively considering relationships among operating units and the six capitals when making strategic decisions. Integrated thinking promotes connectivity between financial and sustainability objectives, encouraging cross-functional decision-making. It is not just a reporting tool but a way of embedding long-term value creation into management processes and corporate governance structures. The integrated report is the external output of integrated thinking. It communicates how strategy, governance, performance, and future outlook interact to create value. Integrated thinking drives better internal decisions, while integrated reporting communicates those decisions transparently. Thus, integrated thinking supports the preparation of the integrated report, and the report reflects the organization's integrated approach to managing and reporting value creation.